Well, welcome back. We've talked a lot about default risk. We've talked about bond ratings and spreads based on creditworthiness. So now we have a reading about the fundamentals of credit analysis. Well, we'll learn a little bit of where those ratings come from, what analysts look at in assigning those ratings, and also some categories of bonds and how to approach them based on their creditworthiness. So that said, let's jump on in and talk about credit risk and start to define it and the components of it. So credit risk of loss if the borrower fails to pay interest or principal. That part is pretty straightforward here. Spread risk is the risk of the spread widening. Now, we talked about that credit spread. We could talk about the nominal spread between the yield to maturity on BBB corporates versus the government bonds of the same maturity. Now, even if that base rate, the government bond yield curve, even if that stays the same, we can have changes in yield for risky credits because that spread can narrow and widen over time and change. When we speak of credit migration, or sometimes we could call this downgrade risk, that's the issuer creditworthiness declines and the bond rating falls. So that's pretty straightforward to understand. And market liquidity risk, I've mentioned to you a few times in combination with credit risk. That's the risk that you receive less than the market value when selling the bond. If it's not actively traded in significant quantities, then when you go to sell it, you're going to move the market and it'll move to your detriment. If you're buying, it'll move higher, and if you're selling, it'll move lower. And so that's what we refer to as liquidity risk there. Default risk is the probability, so that's just a percentage number, probability of default over some horizon, some time horizon. Now, given that they default, we need to look at the loss severity, the amount or percentage of principal interest lost if the borrower defaults. So that has to be estimated, but in some cases that might be just about all of the value, and in other places maybe it's only 30–40% of the value, depending on the collateral and other considerations to do with the credit that's been issued. So the expected loss we're going to define as the default risk, that's our probability, times the severity. So if it's a 40% loss with a 10% probability, then that expected loss is 4%. So the recovery rate is 1 minus the loss severity in percentage. So if the loss severity is 45%, the recovery rate is 55%. So nothing very confusing there, but you do need to know these terms, and there'll probably be some questions on them. And what about the priority? Well, seniority refers to where creditors stand in line in their priority of getting the funds. And bonds from the same issuer may have different seniority because the bonds have different characteristics, different collateral, and different priorities. So a first lien or mortgage bond has priority, or is senior to, we could say, second lien mortgage bonds. And in general, secured bonds, those that are backed by some sort of collateral, have a greater seniority than unsecured bonds. And to continue the terminology, the senior bonds are senior to the junior bonds, which are senior to the subordinated bonds. So you need to learn that terminology. And some issues may combine these features. We may say it's senior secured and junior secured. So in that case, they're both secured debt. They're both backed by some sort of assets or collateral. And yet the junior secured has lower priority and is less senior than the senior secured bonds. And we have a term for all debt that's in the same category. That is, if their seniority ranking their priority is the same, we say that they rank pari passu, that they have the same priority of claims. We may have occasion to use that phrase in what follows here. Now, what about the priority of claims in bankruptcy? Well, there's a strict priority of claims, right? That's all spelled out, just like we were talking about. Who has the first claim to the funds, who has the claims to the collateral, which are unsecured, all the way down the line. So this strict priority of claims, the only point here is that they are not always followed in bankruptcy. Now creditors, and this has to do with the bankruptcy process and the negotiating process and whether they want to get it done and how rapidly they want to get it done and how deeply involved the parties want to be in the negotiations and a lot of things like that. So the outcomes are not always predictable based on strict priority of claims. So the creditors may negotiate a different outcome to limit delays and bankruptcy-related costs. Of course, the longer it drags on, the lawyers are charging by the hour, and these guys are not cheap. Bankruptcy court may order a different outcome. And if we look at equity versus debt, that's often negotiated as well. They want some senior management to stay. There has to be some equity portion of the business to give an incentive to run it and run the company, so those may be negotiated as well. Well, the three main credit rating agencies are Moody's, S&P, and Fitch, and they will assign a corporate family rating, a CFR, and this is for the issuer, not for a particular bond issue, but it's the issuer credit rating, and if they have senior unsecured debt, it will apply to that. So that's the corporate family rating for the issuer, and that is going to be the rating for the firm's senior unsecured debt. Other debt may have priority to that or less seniority than that. And when we talk about the corporate credit rating, that applies to a specific debt issue. And adjusting from the CFR to the CCR is a process called notching. And so the rating may be notched up or down from the CFR, which is the senior unsecured debt. And notching adjustments are larger with the lower corporate family rating. That is, if it's very highly rated, if it's a AA credit, then these notching adjustments aren't going to be very significant or serious. They say, well, they're a very good credit, so the difference between the claims of this bond and the claims of this bond just aren't that big, so the notching is lower when the corporate family rating is higher, and vice versa. Here's just an example. I think you've seen this in the notes as well. You should familiarize yourself with this, and also the difference between investment grade and non-investment grade. Non-investment grade, sometimes called high-yield bonds, sometimes called junk bonds, but they're certainly called high-yield bonds by those that are trying to sell them. So investment-grade bonds go down through triple B with S&P and Fitch, and then we get to double B, and that's the beginning of the non-investment grade. And then over here on the right-hand side, we have C and D ratings. These are bonds that are already in default. These are bonds here that are very risky, considered to have the highest default risk there of falling into a C or D rating in default. I like the S&P's D rating because D stands for default, and I find that easy to remember. What are the risks in relying on credit ratings? Well, they just may be wrong, huh? And that could be costly. Credit rating may change, right? You rely on a credit rating, and then S&P comes out the next day and says, well, we're taking a look at this with a possible downgrade and negative implications, and there you are. That means yield up, price down. Rating agencies make mistakes. Certainly they do. They're often looking backwards, as we'll see, at financial ratios and indicators and financial performance. And as things change, sometimes they do, well, they don't have a crystal ball. Issuer-specific risks may be unpredictable. Well, litigation risks, natural disasters, and leveraged buyouts, well, those are hard to quantify before the fact. Prices and spreads adjust faster than credit ratings. The market is always adjusting the yields and spreads, prices of these bonds based on anticipation of future events and interpretation of current financial events. So the ratings assess default risk, but sometimes, and what we're saying here is that these yields are going to move before the ratings move, at least to some extent. So spreads are going to reflect the expected loss, and ratings, remember, just assess the probability of default. So there's more information in the spread than there is in the ratings. So the components of credit analysis, I've seen 3 C's, 4 C's, 5 C's, 7 C's. These 4 are good ones to give us a framework to look at credit analysis. The first one is capacity. Does the firm have the ability to pay on time and in full? And this will have to do with its solvency, its leverage, how much financial leverage it has, what the obligations are for the payments on their fixed income debt, all these sorts of things. So look at the company, look at the industry, look at the stability, look where you are in terms of how much they are paying on their debt right now compared to their cash flows, things like this. So that's the actual capacity. Collateral, well, we also look at that, the value of the hard assets of the firm, whether they're pledged or not. A firm that has more physical, saleable assets that are in liquidation closer to their carrying values on the balance sheet, well, that's going to offer overall more credit protection to the lenders, the bondholders. Covenants, we've talked about covenants. Do these legal stipulations of the bond issue, do they protect the creditors to the degree that they should? And character, management integrity, that's probably a little broad. You want management with hopefully some track record of trying to honor or in fact honoring their debt obligations in their work at other firms. The firm's behavior in the past certainly be considered here, but other than that, other character seems a little broad. We're looking at the determination and intent to manage things in such a way as to satisfy the claims of the debt holders, the creditors. So how about capacity? Well, I guess we can look at this from the aspect of Porter's 5 forces too. One way to look at it. Power of suppliers, power of customers, barriers to entry, substitution risk, and level of industry competition. Now, I think we've seen Porter's 5 forces, or will see them, depending the order you're studying things, in other areas of the curriculum as well. But at least they stay the same. Power of suppliers. Well, if there's only a couple of suppliers of key raw materials, then they can extract profits from the company when things go well. And so this isn't really good for creditors. Okay? A lot of suppliers that are very competitive, that's better for the company's position. And also the power of the customers. If there's just a couple of customers, they can squeeze down prices. They have some market power in the negotiation of prices. If we have lots of spread out customers, then there's less power to the customers, and that's better from the standpoint of looking at the prospects of the firm. Barriers to entry. Well, companies always look better when there's barriers to entry. They're protected to some extent from competition. That gives them pricing power, the ability to earn higher operating and net margins. Substitution risk. Well, again, it comes back a little bit to pricing power. That is, if this industry, if the players in this industry raise prices, will people switch to a different product? So how risky is it that they'll substitute to something else? And this wouldn't have to be from pricing pressure either. This may just be substitution as technology changes, which is darn hard to quantify, but certainly very important in the ongoing capacity to meet their debt obligations. And the level of industry competition. The more robust the competition is in the industry, the less pricing power each individual firm has, and this is kind of a negative as far as the capacity to meet their debt obligations. More on capacity. We'll look at the industry fundamentals. Of course, their growth prospects. That's what I mentioned. We've got to look at some forward-looking things, but we're always estimating, always forecasting with some amount of error. So if it's a cyclical industry, then we want to say, are they going to be able to make their debt payments in the down part of the cycle? Company fundamentals, competitive position, a little back to Porter's 5 forces here, their operating history, certainly want steadier growing earnings are what you really want to see. Deviations from that, less so. how have they done with their strategy, and if they had the right strategy, did they execute it well? And of course their current ratios, their leverage ratios and their coverage ratios. Remember, leverage is going to be your debt to equity financing, and your coverage ratios are going to be some measure of earnings or cash flow, often EBIT over your fixed interest charges. So we like a higher coverage ratio and a lower financial leverage ratio. Makes the firm look better to the bond rating agencies. Okay, so we made it through capacity. That was kind of a laundry list, but now we can just talk about collateral. Examine the depreciation expense. This is advice to analysts, or an indication of how analysts approach this. High relative to capital spending may imply insufficient investment and low quality assets. If the stock price is less than book value, this may indicate low quality assets too. We can think in general that these assets are carried at their depreciated cost, book value, and if the stock price is lower than that, this is an indication that, well, those values they're carrying them at may be a little bit inflated. Okay? Investors just aren't believing it. Intangible assets that can be sold, well, intangible assets can be just as valuable as tangible assets. We know that patents are worth huge amounts of money now and subject to a great amount of lawsuits amongst the technology companies because of their great value. And intellectual property can also be a valuable thing. Now, whether that can be a source of cash and liquidation, who knows? But I guess some is, some isn't. I mean, if we're talking about our company, all our content is considered intellectual property, and is probably a good part of the value, except for our obviously great goodwill of our customers. So they can be sold. They have value as collateral. We can add those to the list. Covenants. Well, we already saw this at some point, or you may have. Affirmative covenants. They must take. Pay the interest, pay the principal, insure pledged asset, pay taxes. These are very common ones. There can be others. Negatives are the ones they can't do. Often it says, well, you can't issue more debt that is pari passu, I knew I'd get to use that phrase, with this debt, because clearly the more debt we do at the exact same level of seniority, that's going to dilute the claim of those that already own the bonds. And so the goal is to protect bondholders, but we don't want to make it so constraining that the firm can't take advantage of opportunities, make investments, pursue opportunities. So hopefully it's not overly constraining, but there's enough protections in there that the bond buyers feel comfortable with them. And character. Management ability to develop a sound strategy, past performances, bankruptcies and restructurings. How have they done at prior firms? What accounting policies? Do you see them using very aggressive accounting? Are there frequent restatements, frequent changes in estimates? Does it look like earnings are being managed to a large part? Those things are kind of a red flag. Fraud and other legal problems, clearly a red flag. And do they have a history of taking actions that favor equity holders over bond holders? And we don't have time to go into it here, but there have been some pretty egregious examples of that over the years, where corporate management has just done what they felt like they could do and see what the bondholders are going to do about it. So anything like that would certainly be an indicator that you might want to look at another company when you're buying some bonds or making loans. Financial ratios. A lot of ratios involved in this credit analysis. Okay? We mentioned the leverage and coverage ratios. Okay? And we could also look at some profit and cash flow metrics. I mentioned using EBIT in the coverage ratios. Sometimes we use EBITDA, earnings before interest, taxes, depreciation, and amortization. Sometimes the measure we want to look at is funds from operations, or free cash flow before dividends, or free cash flows after dividends. Let's take a closer look at these leverage ratios. We know higher leverage is higher credit risk. So analysts, it's suggested here, analysts should adjust debt to include all obligations. So this would be liabilities under underfunded pension plans, off-balance sheet liabilities like operating leases. Deferred tax liabilities have to be examined and determined, are they expected to reverse, and over what time horizon are they expected to reverse. Now, if we look at a debt to capital and debt to EBITDA ratios, higher leverage, and the analyst may want to adjust capital for a write-down of goodwill. And funds from operations to debt, again, higher ratio, lower leverage. So you should at least know which way you would rather see these ratios go if you are lending money to the company. I would say at a minimum, be able to do that. Here's some coverage ratios, either EBIT to interest expense or EBITDA to interest expense. EBIT is more conservative. Why are we saying before depreciation and amortization? Because those are non-cash charges. We're kind of backing into almost a cash flow from operations sort of measure here. Not exactly the same thing, but it's the same idea where we take net income and add back under the indirect method those non-cash charges, depreciation, amortization. So let's look at an example with some numbers. This stuff is not really tough. You just look at which company has the best ratios or the best position, and they've got the best credit quality. So even any questions you get in this regard, as I say, if you know which way is better on these ratios and on these measures, then shouldn't be too much trouble. So in looking at this, we've got the operating earnings, EBIT, we've got funds from operations, we've got interest expense, total debt, and total capital for two companies, York and Zale, and the industry average. And then we have some notes to this. And we're going to focus here a little bit on analyst adjustments to these reported numbers. York has goodwill of $500 and operating lease obligations with a present value of $900. Zale has a net pension liability and no operating leases. Industry averages are goodwill of $200, PV of operating leases of $200, and no net pension asset or liability. So that's going to help our comparisons here as we move through this example. So let's focus first on these recommended analyst adjustments. Okay? We mentioned before, off-balance sheet liabilities include operating lease obligations and net pension liabilities in total debt. That shouldn't be too hard to remember. Those are both liabilities. They both have to be paid. We haven't mentioned any DTLs, deferred tax liabilities, that are going to take a little deeper dive in order to figure out how we want to treat those. And calculate debt to capital ratios with and without goodwill. And that's going to tell us, well, how significant is this indefinite intangible asset goodwill? Without that, how bad would the ratios look? That's what we want to find out by doing it with and without. So here it is. Our EBIT to interest ratio for York is 13.8. For Zales is 14.1, and the industry average is 14. Well, we could say two things about this. We could say Zales is in the best position according to this metric. Another thing we might say is they're all pretty darn close together, and it's a tough call, especially since they match the industry average so well. Funds from operation to debt. Funds from operations represent 15% of debt for York and 31% for Zale. I would think that puts Zale on the good side of things, and to make it easier to interpret, Zale is significantly above the industry average, and York is significantly below the industry average. Debt to capital ratio, well, 47% with goodwill, 54% without it. Nothing too dramatic there. I guess Zale doesn't have any goodwill. We are only reporting the debt to capital ratio of 41%, a little bit lower than York, and the industry average 43%. And 44% if we back out goodwill based on those descriptions of the assumptions for the average company in those ratios. Now, in a question on the examination, it's been my experience, and it is my belief, that they won't point two in one direction and one in the other and make you vote because of the two. But if they did, fine. I'm certainly not going to pick the company that has one better ratio and is worse than the other two, because we don't have any weighting scheme, so don't overcomplicate this. But it's been my experience that in these types of questions, they will point all three in the same direction. I think here we have, what, two in the same direction and one that's also in that direction, but a little less severe, a little innocuous. But that's what you can expect. So that's why I say, know the right direction, you're probably good to go on these things, especially in a multiple choice format where you don't have to actually perform the analysis yourself. Okay. So here's the analysis at the bottom on this slide. York and Zale have interest coverage, EBIT to interest charges in line with their industry average. So yeah, that one's so close. Yeah, no big call on that. Adjusting for all obligations, York is more leveraged than Zale and the industry average, and Zale is less leveraged than the industry average. Therefore, Zale appears to be more creditworthy than York. So I hope you don't disagree with that. It seems pretty well supported. Zale has lower debt to total capital and higher funds from operation to debt, makes it the better credit. In both cases, they're above the industry average, and in the other case, York is below the industry average, so in the other direction. If you knew it was that easy, you'd want to get a job in credit, but it might be a little more difficult than that when you try to get right down to it. Okay, yield spreads. What about the level and volatility of yield spreads? Well, we talk about these yield spreads as having components of the credit spread and liquidity premium. Liquidity premium is significant, but it usually doesn't approach the significance of the credit spread. And what are the factors that are going to affect these? Well, the bond quality. Spreads tend to be more volatile for lower quality bonds than for higher quality bonds. That shouldn't be too hard to remember. Okay? Lower quality bond, more uncertainty, more volatility and bouncing around of the credit spreads, the spread to the risk-free securities or risk-free yield curve, depending on how it's measured. And where are we in the credit cycle? Spreads narrow when credit is most available. During an expansion, everybody is optimistic. Things are going to get better, earnings are going to rise, demand's going to increase, everything's great. Well, in that sort of a world, the spread between a BBB bond and a AA bond may get narrower. The perceived difference in credit risk between them just is not that big. But now, think about an economy that starts to slow down. People wonder where it's going to hit next. Is demand going to fall? Is unemployment up? Consumers have less money to spend. All of a sudden, a BBB credit versus a AA credit, it looks relatively more risky compared to the AAA credit. And so as we go into a contraction or into a recession, those credit spreads tend to widen. So it's the availability of credit, but at the same time, it's the perception of riskiness in the lending and bond markets that can change with sentiment over the credit cycle or the economic cycle. Economic conditions, spreads narrow. Okay, I just said that. Corporate cash flows improve and spreads narrow during an expansion. But market performance can also affect these spreads. Spreads narrow in strong markets and also in steady, low volatility markets. Again, less nervousness about the future, narrower spreads. Equities doing very, very well. Yeah, that'll tend to narrow spreads as well. Factors affecting spreads continued. Broker-dealer capital. When broker-dealers have a lot of capital to commit to bond trading, spreads are narrower. When they don't have a lot of capital to devote to it, those spreads are going to widen. Supply of new issues, a high new issue volume. If there's a lot of new bonds coming to market, well, that's just supply and demand. A lot of supply coming in drives prices down, drives yields up, and that increases the spread. Okay, bonds categorized by credit rating, bond rating. Higher default risk than investment grade. And this means an increased focus on loss severity. We mentioned a little earlier that loss severity for high quality credits just may not be as bad and usually less than for less strong companies. And let's look at their sources of liquidity. That's the idea. How are they going to make these debt payments if things don't go as well as expected? We're always looking at the downside, the risk of default here. So sources of liquidity, cash. That's a reliable source of liquidity, and it's hard to lie about. The auditors can just call the banks. Working capital and cash flow from operations. Again, two sources of cash, two sources of liquidity over the short term. Bank line of credit that are open lines of borrowing. That's certainly a source of liquidity. How are the equity prices? Is equity issuance to raise money a real possibility? And asset sales. Well, that's getting down to it. I mean, once they're selling assets to make their debt payments, either interest or principal, things have gotten pretty grim. So that's the order that we put these in. But it could be kind of a tertiary sort of source of liquidity. More about high-yield bonds. We need to project the future earnings and cash flows, including stress scenarios. So these high-yield bonds, we're going to analyze the company a little bit more like we would for an equity security and a little less than we would for a higher-rated bond in doing the analysis. So we need to analyze the debt structure, estimate leverage, loss severity for each seniority, for each class of bonds that are outstanding. If there is a top-heavy capital structure, that is, a high proportion of secured bank debt, the firm has less ability to increase borrowing in a stress scenario. Higher default probability, lower recovery rate for unsecured debt. So these are some of the considerations with high-yield bonds, but it's turning into kind of a laundry list of those. We need to analyze the corporate structure. The debt may be issued by a holding company, an intermediate holding company, or a subsidiary. So, well, you analyze the corporate structure, but you're really analyzing the bonds as well to see where their claim to corporate funds is. Do they have claim to the parent company? Is it just from one of the subsidiaries? And if they can't pay it, you've got no way to go. So you just need to look at the structure of it, but that's all kind of goes back to looking at the bond and the other bonds the company has outstanding. Structural subordination. With structural subordination, subsidiaries must service their own debt before sending dividends to the parent. So holding company debt is effectively subordinated to subsidiary debt. So you need to be aware of that structure. And the more protections for bondholders, the better in terms of lower yields, higher ratings, better prospects for the lenders. Analyze the covenants. Well, we haven't talked about some of these. We haven't talked about a change of control put where the bondholder may put the bond back to the issuer if the issuer is acquired. So if they get acquired and you get new management in there, well now, remember we wanted to care about the character of management and their track record? Well, what if they get taken over by a group that is known to abuse bondholders egregiously? Well, it would be nice in that situation if there was a change of control put on the bonds that you hold. Restricted subsidiaries. They're designated to support holding company debt, so no structural subordination. Limitation on liens, limits on the amount of secured debt. Okay? And think about it, if we had all unsecured debt, then it's all in general backed by the assets of the firm. But once we start pledging specific assets of the firm, if there is secured debt and we've pledged almost all the assets of the firm, then the unsecured debt is in a worse position because there's very little other assets for them to look to if things go wrong. Restricted payments to equity holders. We mentioned that a couple of times. It's typical that the company cannot pay dividends to their equity holders unless they are current with their payments of interest and principal on their debt that's outstanding. Okay, from high-yield bonds to sovereign bonds, those are usually different things, not always. They're issued by national governments, sovereigns, and in this case we want to analyze both the ability and the willingness to pay. It's kind of like we did with capacity and character, right? The ability and willingness to pay their debts, and we can look at their track record in this regard. So bondholders really have no means of forcing an unwilling sovereign to pay its debt. Well, that's true. We've had some incidences lately of seizing assets in various parts of the world to satisfy debts. But in general, you certainly can't force them to write a check. You can't take them to court. Bonds may be denominated in local currency or foreign currency. And remember, lower default risk, that's probability of default with foreign currency because they can print that or tax that or otherwise come up with it. If the bonds are in a foreign developed country currency, it's harder to come up with that currency. They have to actually buy it in the foreign exchange markets, and so they will have higher default risk and may have lower ratings compared to the bonds that are issued in the home currency. How are we going to analyze these sovereign bonds? Well, we want to look at the institutions in the country. How do they work? You know, and what is the commitment to repay the debts? You know, how well do they do with the rule of law, and are they steady at it, or do things change from time to time as different heads of state move through? Economic prospects, the growth rate, per capita income, demographics. Is it an aging population? Is it a young population? Our investment in physical assets increasing, per capita output and per capita incomes. Our third one here, international investment position. What kind of foreign exchange reserves do they have versus their external debt? Fiscal flexibility. Do they have the ability and willingness to increase taxes if they need to pay their bills? And decrease spending to service debts. Well, we've seen a lot of talk about this with some of the countries, not necessarily those with their own currency, but some in the Eurozone, looking at their determination. So, monetary flexibility, central bank credibility, ability to pursue domestic investments. So, all of these kind of macroeconomic stuff comes into play when we're talking about the creditworthiness of a country over time. And municipal bonds, we have these in the U.S. We've called them tax-exempt bonds. They're issued by governments, agencies, sewer districts, airport projects, things like this. And we have either general obligation bonds, and that's the full faith and credit of the municipality. So perhaps the state of New York has some tax-exempt bonds outstanding, and they are backed by the full faith and credit of the state of New York, including their taxing authority. So that's where the claim comes to the funds. Now, if there's a particular project that's being funded, like a bridge that's going to collect tolls, or an airport that's going to collect fees and rents, okay, the bonds may be revenue bonds. And in this case, it's not an obligation of a particular municipality, but of the project. They have a claim to the money earned by the project, and that's it. So at least initially, revenue bonds are considered typically not as strong a credit as general obligation bonds. However, Once you get past the startup phase and into the project, you may find revenues are higher than had been projected, and they can turn into very good credits because they hold on to the money and it's sitting there to service the bonds. Okay, general obligation bonds. Tax revenue depends on the local economy. So we want to know, is the local economy, all one industry? How resilient is it? How's employment? How's per capita income? Valuation of the properties sometimes goes into the strength of the tax base. And those are the things we want to look at in the case of municipalities issuing these tax-exempt bonds. Sales taxes and capital gain taxes are cyclical. Take that into consideration. What about their long-term obligations? We've seen a lot of talk and reporting about municipalities that in lieu of offering very competitive wages have offered very nice pension and retirement packages, and given government accounting, sometimes those don't show up as liabilities, so they are very palatable to taxpayers, at least in the short term. But we've also seen some talks about what the size of these liabilities really are, especially in some cities and counties that have had slowing growth, exodus, and things like this. Those obligations are looming huge on those and have led to some bankruptcies of municipalities. Inconsistent financial reporting requirements. Yeah, governments have their own reporting requirements, and they're a little bit different, and not always compliant with what we would think of as SEC, Securities and Exchange Commission reporting requirements, or generally accepted accounting principles for that matter. With revenue bonds, as I mentioned, it's on the project. You need to analyze the project. Things I've seen, sometimes projects are delayed at the beginning. Other bonds back in the 80s, everybody was building nuclear power plants, and they all had cost overruns, and they all went bad, and a lot of those bonds did not get paid. Those were revenue bonds for these huge utility buildings of multiple nuclear reactors, which was all the rage for a while, but then really kind of subsided dramatically. And debt service coverage, revenue versus payments. So sometimes delays at the start of the project. What you really want to know is what's their source of fees and revenues, and what's your projection for whether what they've said they think they're going to generate, can they do that, can they do better than that, or is there significant risk with this type of project?